final session. Instead of a review and discussion, we are going to start something, and then we'll some open problems that integrating real and financial sector, some of the open issues and the way to see it. What Amit will start, and then I'll also be there to discuss. So, and then we can have a discussion at the end. Yeah.
Okay. Okay, you all must be quite tired, and my voice is breaking already. So let me start with something slightly dramatic. Because you remember when Anjan Mukherjee gave lectures and one of you or two of you asked the question, he said, yes, financial crisis happens, it has always happened, it happens. And this is the conventional wisdom, that in a certain way this has been going on through the history, if you start with these tulip booms and so on. But we want to start with the opposite statement, which is by a contemporary Greek philosopher, Buddha, Gautam Buddha, which says you do not step into the same river twice. Many of you have heard this. And this, you do not step into the same river twice, is exactly like a financial crisis. Financial crisis does happen, but but you do not have the same source and the same origin of the financial crisis. And one of the reasons when you try to understand abrupt transitions, this, that, and so on, one of the things which you should concentrate on is that what is the nature of the crisis. Like just before, we had a very nice lecture where we saw how many banks can fail, almost without any reference to, or rather subsuming all the references to the notion of vulnerability and diversification. Now, we want to start, rather than talking about abrupt transition and so on in the beginning, we want to start by, whose water is this? We want to start from the other end. That is, rather than saying, critical points, transition and so on, how do financial crises, what are the sources, what are the mechanisms by which financial crisis can occur? And it's a much more primitive question, much more simpler question, and a question which is absolutely essential to understand before you, if you're actually, that is, what are the broad mechanisms? Can we classify them? Can we classify them in a meaningful way and so on? Having thought about it, well, over several years now, I think you can basically, at least for the way of organizing your thinking, you can think of three different ways, and I will show the kind of formalization, mathematics, and so on, which you can do around it. There are three different kinds of mechanisms you can think about by which you can talk of financial crisis and sudden transition. That is, it is true you do not step into the same river twice, but still there is a river and there are certain mechanisms which have certain degree of, some degree of commonality with some of them and some not so common in the other cases. The first mechanism, which we have been trying for some years to capture, which is the typical economist's traditional view of a crisis. And that traditional view of a crisis is there is a systemic risk. What is the first one? Macroeconomic between the real and the financial sector. Yes. The second one is the one which economists usually talk about. That in some sense, the real sector is the, your households, in economist jargon, You have the households and you have the firms, like in Keynes, like in Marshall, like in, Friedman and everybody else. You have the firms. So you have the real sector, and you have a kind of sector whose role is still not very clear, which you call the banks and the financial sector. They are like, originally they are thought to be like lubricants to the system, like they make the whole machinery work more well. But now we know that it's much more complicated. They also bring in uncertainty, they bring in other things. But there is a large banking and financial sector, and there is a real sector. And it is a kind of misalignment between the two, which causes one kind of crisis. This is one source. This is our number two. And the first is what you saw just before, that you can have a systemic risk. The whole system may be prone to risk because within the financial system itself, there are problems. So the financial system itself, what you are saying, even, you might have a very vulnerable system in some ways, and it will lead to breakdown in some ways. Put in these ways, words can be highly misleading. So we thought what we should do is, for each of these cases, we will try to present clear a kind of not formal structure, a way in which these ideas could be formalized, and then you can go further. You want to take over? I can't. Okay. I can't speak actually.
Okay.
Huh?
Okay, I'll do. So, okay, so the misalignment between real and financial sector due to failure of aggregate demand. So this could be the two ways you can think about it. One is the method of financing consumption. Okay, we talked about this. You have two ways to expand in a closed economy: consumption expenditure and investment expenditure. So consumption expenditure depending on not only your disposable income but also your
Y is equal to C plus I.
So consumption is not only your disposable income, depends on disposable income, but also your the capital gains that you get from financial assets, holding financial assets. So in that scenario, you'll see the consumption leading to households over indebtedness. As your capital gains is increasing, you can actually you have your value of collateral is increasing. You can get more loans from the bank. That creates, so debt-driven consumption-led expansion. That's what here it means. Households over indebtedness to banks and their obligations ending up in the financial sector securitization. This basically means that as your loans are given by commercial banks, which are further securitized. Yeah, which are further securitized.
Oh, you need this.
No, it's fine. This is enough. Yeah. So you have commercial banks. So you have households getting loans from commercial banks, and the loans are further invested into the financial sector or off-balance sheet or special purpose vehicles, as you may call the financial sector, which are securitized, right? So that securitization in turn comes back into the system. People can actually, households, firms, or banks can buy these securities, and the capital gains that comes out of these financial securities is another source of income stream to each one of these entities. So this process can actually lead to further lending from the commercial banks and so on and so forth. So you have the method of financing commercial consumption from your over-indebtedness to banks, which is facilitated by the credit expansion, further credit expansion facilitated by the securitization process itself. So over-borrowing from by households can also arise from they can also purchase equities. This is the entire process. Okay, so if you want to see it clearly, we looked at it very briefly last time. We saw this. I'll just show you remind you what we saw. Sorry. Yeah, this one. You saw this matrix that was going around. You have seen this type of matrix, balance sheet with Zetsa yesterday, right? So in this, we talked about this. The underlying assets are basically the loans that are going from the commercial banks, which are going into financial sector on which they securitize, F, which is further lent, further bought by the other sectors in the economy. Okay. So this leads to a expansion of credit, consumption demand, expansion of credit, expansion of securities. And that was the first point. And this is in the household sector. So you can also have this in the, so this is the household sector's portfolio management. So that's where the consumption is led by your capital gains. You can also have the second component, which is the investment expenditure, which is the firms financing investment through equity or credit from banks. Okay, so firms' expenditure in turn can either be loans, okay, got from the banks, and also they have, when their expectation of sales is not realized, that's where they have the problem of aggregate demand. So they actually issue equities with an expectation that they will sell more. If the sales expectations are not realized, the realizable profits are down. So so your investment, the expansion through investment is falling. But if the expansion through consumption is more than outweighing the fall in investment, aggregate demand will increase. But if that fall in real investment is more than outweighing expansion in consumption, then you have a aggregate demand issue, failure of aggregate demand. So in all such cases, aggregate demand failure leading to income failure for households. Okay, this is also Zetza was talking about this point, and firms leading to default, which causes insufficient liquidity in the financial sector. So as default increases, you saw morning's lecture, Shrikant talking about liquidity crunch in the system. So this part of how capital gains expectations may set off this process of self-reinforcing interaction between financial sector and the real sector can be seen in this paper. That paper is, that's one of the preliminary reading we gave, and it's still on the website. There's simple, so you can see how two kinds of regimes, aggregate demand regimes that arise. One is consumption-led, other one is financial investment-led, and so on. So that is there. The second one, okay, second one is this part that the systemic risk. Okay. So the second way of possible source of systemic risk. Okay. So what we have done is you want to talk on this?
No. Okay. You explain the matrix.
Okay. So the second possible source, you can think of the whole economy in terms of a three sector. Okay. It's a very, very simplified, very crude representation of a macroeconomy, but we wanted to get that the interlinkages between the real and financial sector in a much simpler way. So we have three sector economy. One is the real sector comprising of households and firms. Okay, and you have financial core, which is basically the commercial banks and the central bank, monetary authority. And then you have the financial periphery, where you can think of investment banks and hedge funds and so on. So what you have seen, the traditional balance sheet that was presented by Zetza, and also just now I showed, and also flow of funds matrix. Okay, all that in a traditional sense. What we are trying to develop here is a cross asset liability matrix, which to bring out the interrelation between these three sectors. Just see this matrix. So you have.
Before that, you should say, this is something which does not exist in the literature. This is our way, and I think a much better and simpler way to represent the whole thing. What you heard, this double, stock flow matrix, and so on and so forth.
Yeah. So what we are doing here is a kind of unique way of representing the interlinkages. Even in the stock flow consistencies, you have different sectors, and the interlinkages is basically defined through the asset and liability ownership pattern of each of the sectors. Here, in a much simpler way, we can bring out the essential interlinkages. So you have the three sectors: the core, which is the banks, commercial banks, and monetary authority. Now here, just the commercial banks. Then you have the periphery, which is the investment banks and hedge funds. Then you have real sector, which is household and firms clubbed together. Okay, so it's like you saw the social accounting matrix yesterday. Remember? Did you see with Zetza? It's quite similar but slightly different. So you have the internal the net liability of each sector is zero. Okay, the transaction between the banks in the core, that cancels out. We assume that zero. So transaction that happens between households and firms that's equal to zero. Internal transaction of each of the sectors is zero. Now, if you read through the row, okay, you take the financial core. So in the row direction, you read the liabilities of the row entry core. What are the liabilities of core held by financial periphery? So the liabilities of core are EB, which is the equities issued by the bank, plus the money held by the financial periphery, right? The money, the liquid cash that is held or deposits held by the periphery. So these two are the liabilities of the core. But if you read from the column, it is their assets, right? The assets of the financial periphery is basically the equities of the bank that they hold in their portfolio plus the cash that they hold. So similarly, if you read again the next entry in the row, financial core, the equities of the bank and the cash held by the real sector. So that is the liabilities for the banks or the core and the asset for the real sector, right? The equities that we hold and the cash we hold is an asset for us, but it is a liability for the issuing entity, which is the financial core. Go down the next row, which is the financial periphery. The financial periphery's liability vis-a-vis financial core is the loans that they borrow from the commercial banks at an interest rate I. So ILCP, it's a core to periphery loans at an interest rate I, plus the FC, the financial securities that the core holds. Financial securities are issued by the periphery, held by core. This entry is a liability for financial periphery, but if you read from the column wise, it is the asset for the financial core, right? The asset of financial core is the loans that it gives to financial periphery plus the financial securities that it holds in its portfolio. And the real sector, again, the real sector's liability is what? The liability is the equities issued by the real sector. It should be EF. Real sector's liability is the EF plus the loans that they get, right, from the commercial banks. There's some mistake here. So it's a loans that they get from the commercial bank, ILCR. The amount of loans that they get from the commercial bank is the liability, but that is the asset for the financial core. And second row, the real sectors vis-a-vis financial periphery is the equities that is issued by the real firms held by the financial periphery. So if you add the row, you get row-wise, you will get the total liabilities of each sector. And if you add the column totals give you the total assets of each sector. So assets minus liability is your net worth of each sector. Okay, now you, yeah.
Yeah. You see, basically, like any matrix, rather than this lots of symbols and so on, along this side, for any sector, right? This is all right. Can you see all of this? For any sector, 1, 2, 3, or you can make it 10, along here, if you read along here, it is a liability. Liability. If you read along the column, it is the asset of that sector. That is the logic of the simple classification. Okay. That is, you take any complicated, like you did yesterday and so on, you take any complicated accounting framework. You look at the items, and the items can always be either treated as an asset of a sector or as a liability of a sector. That's, after all, the double entry format means. And each one is just showing that. I mean, there are too many notations, so it might not, it might hide you. So you have this, okay? Now, once you have the asset liability structure, so you have 3 sectors, and you assume that inside the sector, for simplification, we are not considering anything. So it is, in usual matrix notation, this will be the liability of, if there are 3 sectors, so 1, 2, 3, this is L from liability of 1 to 2, liability of 1 to 3, liability of 2 to 1, liability of 2 to 2, and this would be the liability of 3 to 1, liability of 3 to 2, and this would be 0. L, L2, 3, sorry, L2, 3, etc. Okay, 3, 1, 3, 2. And if you add up, as he said, if you add up, you get the total liabilities along this, you get the total assets along this. Now, this was the first step which we took to make it, trying to make it into a kind of theory of transition. We'll say what happens next. Now, for the time being, assume that this asset liability structure remains reasonably stable to start with. Or you take a, just like you did with Leontief's input-output table. Those of you who have done this, you look at the, or national income accounting, you look at a particular year and you look at the transactions which takes place and you just, okay, you report it. Then if you divide it up, you take the total liabilities, call it L1, call it L2, call it L3, capital. Okay. If you take the total liabilities of this, and similarly you can get by adding here, as I said, the total assets or net worth of a sector. If you take the liabilities and if you divide them up, then you get what? A non-negative matrix with all elements which are positive. Okay. Very similar to a Leontief matrix. Next one. Now, at the moment, we are at a stage where we just want to see how far we can go in the understanding a financial network by analogy, because that's one of the biggest source, symmetry and analogy are the biggest sources of, for those of you who are doing research, of trying to get ideas. That where do ideas come from? It either comes from analogy or some notion of trying to look at symmetry. If you're looking. So you look at exactly like the dividing a sector, we get the non-negative square matrix, 3 by 3. Further, if we assume 1 unit increase in liability of sector J as an exogenous variable, this is what he was saying, that you know, that if you have this, will not work. I think something has gone wrong. I think something came off here. Oh, that.
Oh, yeah, okay.
Yeah, good. Sorry. I tend to make a mess not only of algebra, but I also tend to make a mess of, as you can see, any gadget I deal with. Now, if you take this analogy further, you have a non-negative square matrix. We have very strong known properties of it. The further, if we assume 1 unit increase in the liability of sector J as an exogenous variable, that is what you were saying before. Suppose the household sector, the real sector, or the firms, for some reason, decide to incur more debt. You don't take it inside more than what is the average, what is already is in the history here. So you take something which they get out of that. Just consider 1 unit increase in the liability of a sector, which is outside this. And this we call by V. Okay, by a column vector V, by a list V, where either in the code it is 1, 0, 0. He has written it explicitly, periphery 0, 1, 0, real sector 1, 1, 0. How it happens is not the question which we are asking now. Suppose it happens. Then you have a matrix like this. You have a set of simultaneous equations like this. Consider an increase now in one element. Suppose the monetary policy decides to inject more money into the system, like 2008. I mean, I'm just giving you, you can do many things. Banks, for some reason, not banks, the periphery, decide to increase their leverage. So they have more, they increase to their own, injection much more. Households do the same thing, decide to borrow more for whatever reason, or feel that the situation is good, so they decide to send more. Put any one of them as 1 and put the others as 0. Okay. Solve these equations. Okay. These are, after all, a 3 by 3 simultaneous linear equation system so far, with 1 here. Solve the system. This is exactly like solving the static Leontief input-output system with final demand, but I'm making a trick of using the final demand with other zeros and 1 for the sector which, just to illustrate, the sector where the original impulse or the original injection is taking place. Now you will see, if you ask in general, not a 3 by 3, even in a 3 by 3, do you get a positive solution? If you know, this is known as the Hawkins-Simon condition, this is known as that is the principal diagonal, I mean the principal minor must change in sign and so on and so forth. There are many ways in which you can write it, but generally you can say either a solution will exist, or unlike in the a solution does not exist. We would guess this would be the abrupt, simplest case of first transition possible. That in some senses a system will go into, it will require negativity for a solution which is not permitted and so on. But this would be a very simple way by analysis. I repeat, it has not been done anywhere. There is, to my knowledge, not a single paper anywhere exists of this sort. And it's an extremely simple framework in which to collect a lot of information in a simplified way. That is, you put it up. If some of you are doing, I don't know, thesis, are looking for a problem and so on, I should not say it because we would be very soon working on it yourself, but it's an open, it is free for everybody. So actually this is, and this is a gold mine. I think you can actually decide either to work empirically on this, but before empirically you have to know a little bit. And all the more or less standard literature of this exists from 1947-48 onwards in terms of input-output table and so on. You want to take the third one? Now, this would be, sorry, can you just go back for a minute? Well, I did not do all this because I tried to keep the, even the algebraic notations completely out. If you write it, okay, it should be, V would be, what, L, I minus A, will be post multiplied by I minus A inverse, right? This is exactly like the Leontief inverse. It will be multiplied by the I minus A inverse. What would each element show? Each element show will the direct and indirect requirement of assets and liability changes in a sector. The change in the assets and liabilities, have we written that somewhere? The change in the assets and liabilities of a sector. Now, there is a viability condition. Just like he has a condition when you will not be vulnerable and you will not go bankrupt and so on. There will be a viability condition, which is the Hawkins-Simon condition, under which it will be possible to say that if you increase by 1 unit, let us say that loan of the, the debt of the household sector or of the firms of the real sector, what will be the repercussions on the banks and on the core and the periphery in the finance? Similarly, if the periphery increases, what would be the repercussions in terms of the assets and liabilities? Okay. Directly and indirectly in terms of all the other sectors. That is I minus A inverse, which can be geometrically expanded for most conditions because it's a non-negative square matrix. You will see these standard results and so on. In Gondolfo, we will, Debru's classic paper in Econometrica,
and you will get this. Okay. From this, you will be able to work out whether there are conditions under which, this is what we'll look for, whether there are conditions under which, if you want to increase loan of, let's say, households by one, what is the asset liability structure of the economy as represented by the simple matrix 3 by 3, under which this will not be possible. It will not give you a positive solution. Then something must give in. What something must give in is a different story. But this means that this is like a critical point. It's like a, whatever you call it, this is where abruptly something has gone wrong. Okay. Now, this would be one way of proceeding with the problem. And I think every element of this is quite clearly understandable, and therefore you can do it. You can complicate it much more. You can take, since we are talking so much about stochastic disturbances and so on, you can even introduce in V, one of the stochastic terms, to say if something abruptly is changed, how much would the system be stable or unstable? Huh? You can do it. I mean, it's sign neutral. The analysis is sign neutral. Okay. Now this is entirely in the realm, as we have put it up. There are three actors in the real sector, in the financial sector. But what we have done actually is to show how within the financial sector, something might, in terms of the asset liability matrix, something might go wrong. Right? Now and now I will give you another example, which is a very simple one, but which is the second element, and which is in Basel III. The Bank of International Settlement and the Basel III regulatory requirement. We were just talking about it a little bit earlier, and it's also tangentially related to the last paper which Shrikant presented. That suppose in some way you aim at a target reserve. You say that, you must have whatever, some bureaucratic rule. You must have 80% of your loan backed by reserve, 70% backed by reserve, What is the term which you use? Banking capital. Well, that K, your capital K. Capital buffer. What is the kind of, in case you have given loan, what is a buffer which you must have? Okay. Take a very, very simple case. Again, I have not seen any paper, but this is again to give you an idea. Because, in my last lecture, even everywhere in the world where I have lectured on to PhD students, the last lecture I have always used on problems which are open. That is, you can pick it up, for those of you who are interested, learn the relevant area of algebra, economics, whatever it is, mathematics to the extent, and then approach the problem. And this is one of the best ways to also learn the subject, because you are driven by a problem and you learn all that is needed for that problem. So, sufficient reserve, the problem, aiming at sufficient reserve can be chaotic in a very precise sense of the term. Let R be the reserve for settlement of default and L the loan advanced. Okay? You can link it to this matrix also, but that I would not do at the moment. Loan advance. So, this is basically, you can think of it as assets and liabilities, how much of your liabilities are covered by your assets, so on and so forth. You could convert it in many ways, but just take the simple case. R is a reserve loan. Dynamics, greater is the gap, higher is the targeted reserve. Okay, the more loan you have given, the more loan you have to raise. Define a new variable, R by L, which is the proportion, all very natural. The fraction of reserve which is covered by the loan, and consider to represent the target ratio, that all your loan will be covered. You can take any other ratio, it will only change the constant involved. Slightly tricky, write the equation like this, and this will give you a logistic curves will coexist, and if C is greater than 3.45, etc., you will get completely chaotic motion. That is, you can target, but you will never reach the target. And another kind of transition which can happen, Like, you targeted something, you thought that you were against the default, but you will be aimlessly wandering around this. So I've given you 3 open areas of problem. One is where a large number of work is done, which might be ourselves in terms of how real and the financial sector can be not aligned. Second is the area. You can hear? Yeah. Second is the area where you write the asset liability matrix, now consider an impulse on it. That is an outside impulse on it, which I called V, and then think of what is the repercussions of it through a simultaneous equation system, and whether it will be viable. Third is a situation where you target a certain reserve and you try to get it. And just one last comment, and you will get actually chaotic motions. The best paper, I think, on this is in Nature by Robert May in 1974. The most standard logistic curve and so on, on which a very large number of papers are available and so on. That it can basically give you, even if an equilibrium exists, where clearly an equilibrium exists here, but even if an equilibrium exists where xt plus 1 is equal to xt, even at that situation, you will basically wander around the equilibrium and not reach it. I want to say something because those of you who have not done anything about chaos, chaos in the formal sense of the term, I just want to say 1 or 2 words. You see, if you have continuous time, it's very interesting. If you have continuous time, you require a 3-body problem to generate chaos. Lorentz equation and so on. We would not go into this. It was first, they discovered it in Nature and so, what do you call it, in disturbance in, in weather conditions. What one found is that you can find a chaotic condition, that is a chaotic dynamics, that is, you have an equilibrium, but you wander around the equilibrium without reaching it. Sort of, it looks like a completely random thing around the equilibrium, indefinitely. There is no convergence to this, even though there is an equilibrium. When I first read it, I was trying to think that why should this peculiarity arise of continuity versus, in continuous time, you require a 3-variable problem, 3 differential equations which will generate strange attractors and so on, much more. But in very, very simple, discrete time, you get chaotic. Like here, you get a chaotic relationship. You consider a gradual increase in the gap, but it will not converge, it will just go around. Why does it happen in discrete time? It can happen in, your cobweb model under certain conditions. It can happen in your logistic equation. That is why it is called the logistic chaos. That is the May's original paper. Not original, it was known. It can also happen, for example, you remember, some of you have done it in school, or not in school, in college, that Newton's method of locating in a polynomial the root of an equation. It might be chaotic if you make a guess wrong, you can go around and it will not converge. You will never get to the root. Why does it happen like this? Because in all trial and error method, now use your common sense, in all trial and error method, you can always miss the equilibrium. You overreach it, you underreach it. You try to correct it, you go still further, overreach it, then you try to correct. It cannot happen in a continuous process, because in a continuous process, you must go through the equilibrium and then you stop at the equilibrium. But in a discrete process, you can go through it. So discrete processes, even with the one variable, the simplest nonlinear case, and you will see this, one could draw diagrams and so on, you could get this to and fro movement, which trial and error method, that is the trial and error method, does not necessarily reduce to equilibrium. You learn and you overdo, then you come back, then you overdo again, and so on and so forth. And this is why this logistic chaos arises. This is point number one. Point number two, which I want to tell you, is if you take this framework and if you think of something at all real, that is, trying to reserve. Reserve is, of course, not one. I mean, the loan is also to different people and so on. And the reserve which you get, I mean, in Basel III and so on, there are some reserves which are actually liabilities of the central bank or liabilities of the, central agency, which is absolutely safe. Then you have, ultimately, you have AAA rating bonds. And it's your guess. I mean, in a systemic, in a situation where there is systemic risk, whether, even if it is a AAA bond, it might become just junk, after a point. This, if you have 2-3 types of reserves, you have 2-3 types of adjustment, but not continuous. Because they will really actually make the situation, I'm not sure whether they will make the situation more complicated or less complicated. A bit like diversifying your notion of, reserve. Does it stabilize or destabilize the system? Simple answer is if you are hit by a situation of, systemic risk, it should destabilize your system even more. But I'm not sure the answer is that simple. Because if you have 2-3 types of reserve, you might neutralize one another in certain conditions. But as I said, these are open questions and very fertile areas again of research.
These are the issues that I wanted to throw open, which is still at the formalizing level. It's not completely solved problems, as you said. It's an open question. So, any reactions, questions, comments?
Just say whatever comes to your mind.
This problem, because the level of whatever capital reserves or anything that several financial firms might have, how does it sort of trickle down through every factors of the economy? I mean, I understand that it's an important factor, but like I'm trying to understand how it sort of flows through the entire economy. Because so you're talking about having sufficient reserves, like aiming to have sufficient. Yes. Yeah, I know capital adequacy ratios. So, but you're saying that there is after a certain point, or maybe there exists one or many tipping points of having capital reserves, which might be detrimental to the system, which might increase the systemic risk. Is that okay?
What I was trying to say is 2 things. Maybe I put it badly. The first one is, you see, after all, they will tell you that you reserve, let us say, 80% reserve or 100% reserve in this example. 100% reserve you have to keep. Now, to keep 100% reserve, you start with something. Okay? And you have a certain loan, and how much you must increase your reserve. After all, you cannot one day, no bank can in one day say that, all right, I buy all the things. They will have to gradually do it. So by next year, we'll do it this. This is what is called, we'll move towards the target. So you move towards the target year by year, day by day, okay? But in discrete jumps, all right? In which case, what we are showing is that in a very simple case, if you're discretely every year, if you're trying to cover the come closer to the target level, you might overshoot the target and you might undershoot the target. Now, this is just the bare outline structure of the problem. Now, in many ways, the problem will get complicated. The first way in which the problem will get complicated is your reserve is not one scalar, is not one quantity. It is not so much money you hold. It will be money, it will be bonds, it will be, various equities and so on, and they will all be graded as A, etc., etc. So, depending on these reserves, if there are more than 2-3 types of reserves, each one will have a target to be adjusted in the bank's mind, okay? So that the total will add up to this. And this different types of reserve will create one kind of complication to the dynamics. Okay, this is one. Similarly, the loans which you have is also not a one type, which in the earlier we saw, to whom you have lent, from whom you have borrowed, and so on. So this will be another kind of complication. But the whole point was to show that even as simple a problem as being given a reserve and being told to approach towards it, discreetly, because you have to do it in real life discreetly. You can't do it, saying that, well, if you have to approach it, every year by raising it or every 6 months by raising it in a certain way, you might keep on overshooting or undershooting, even a fixed target, by the very nature of the problem. I mean, it is counterintuitive. I had not thought about it, that it can lead to chaos. But when I started thinking of it as a formalism, it looks like, so that, you set the target, but you don't reason, you just go around it.
So in some sense, it means that it would undermine the authority of a central bank.
Oh, you are speaking.
Yeah, so I'm saying, like, if you'll bring this regulatory requirements from the Basel III on the reserve requirements for the banking system, it would in some sense undermine the role of a central bank in determining its liquidity adjustment facilities for the commercial banking system. Because as of now, like for RBI, we have this liquidity adjustment facility where the RBI decides the liquidity surplus or deficit in the economy based on the capital flow movements in the economy. So if Basel III norms would bring in more reserve requirements for the banking system and there would be a discrete jumps in it, it would be very difficult for RBI to monitor its liquidity adjustment facility over time continuously. Is that what you are trying to say?
I mean, if this is a description, that's the bottom line. That it will be far more difficult than they realize, but this is only, because you will actually never see that target necessarily being fulfilled, even if they are actually trying to close the gap between their loan and their reserve in a discrete way.
So, are you saying that this? The word is adopting increasingly, basically, rules-based fiscal policy and monetary policy. So, this rules-based fiscal policy, in this case also, it's
completely rule-based.
Yeah. So, we should are you saying that we should not go for this rules-based fiscal policy, or should we go for
I mean, the mathematics doesn't tell you anything about that. I mean, the rule-based policy in this particular case has obvious problems. I think which needs to be explored, because actually that rule, whether a rule is or more exactly, whether the rule is a satisfiable rule, it looks like a rule which can be very easily decided, but is it really a rule which is decidable? That you should fix this target. I don't think this is quite true. That it is setting a target is as simple a matter and telling another agent that you should fill the target. This is such a simple process because it does not work like that.
first problem when you were talking about there is the integration between real and financial sector is not feasible. Is this the
No.
first?
The not feasible is too strong a word. That it might be misaligned, I think is the word that they may not be, something might go wrong in their, okay.
So is this something related to demand side and supply side lags which will be created? Because we are trying to integrate, and after the financial crisis we might have understand that there is still, every time there will be a lag in the adjustment between demand and supply side factors. So there is less of possibility of integration between these factors. Should we understand it like that or no? Or like what in my mind, what is the point is that in Indian economy, most of the time what we find is that things are not working maybe because of the supply side constraint. So when we are talking about real and financial sector integration, so will the supply side and demand side factors will play a role in it, or are we talking about something else?
Well, the macroeconomics which we have presented, including the very first lecture, is basically how the misalignment can take place from the demand side. And there is a reason for this. The demand side is the demand side meaning what it means by the market fails. Not the market fails, the market, your sales expectations are not satisfied. Okay. If your sales expectations are not satisfied, then to some extent your income is not realized. If your income is not realized, then what kind of problem it can cause? If you mean by supply side in terms of the finance or the loans which you have received in repaying it, there is a connection. In that sense, you can say there is. But our case is much simpler that, if this happens, then it creates some peculiar impulse in the economy, right? Because you default, and now it is up to you to say if you have defaulted, in what way. To my mind, they are all problems which arose one after another from this. If you have defaulted, then what is sufficient reserve? Can we say this? Not so simple. If you have defaulted, can we say whether the default arose because one particular sector in the economy was particularly bad or worse? For this, you have to go back to what I did as the direct and indirect matrix and do it. So that is the way to, demand and supply side is not exactly the way to pose a problem. I was actually trying to answer the question, that if for some reason there is a default, possibility of a default, then what is the way in which you go about it? And it looks like at every step there is a different kind of formal problem which you come across.
I don't even know whether my question will make sense, but
I do not know whether my lecture makes sense, which is much more basic.
So say that we achieve what Basel III is prescribing, that suppose there is a default and there are enough reserves to rescue the whole economy. But say the crisis happened because there wasn't enough demand, as you were saying, right? And that's why they defaulted. But the central, say there's a central bank, has come to the rescue. Now, won't this still not solve the problem? Because say again in the next period, they have got all their money, it's been recovered. But then again in the next period, there is some sort of, they aren't being able to realize, profits or whatever. And there is again a shortage, again they are rescued. So won't it still not solve the crux?
Well, it's a very good question, but it's not a question on the formalism. And I will give you an answer because it's a very good economic question. And it's actually a very practical question. Because this is what exactly happened in 2008, end of, what was his name, Bush's administration, when they were talking about, you remember, a financial meltdown and first 700 billion and then more and more packages were injected and so on. What happened in the process? Forget about the politics of it. What happened in the process? A large number of firms which are not supposed to be, a large number of financial firms which are not supposed to be covered were also rescued in the process indirectly by not allowing them to fail. And of course, also the direct ones. Okay. Now, that was probably the last time I had gone to America before this. When I said that this is, I meaning not I alone, but many other people, I said that this is not a solution. This is not even a Keynesian. Even unlike people like, what is his name, Krugman and Stiglitz, who are saying that, now we have become Keynesian. It's not a Keynesian solution. It's a solution, half solution, Keynesian solution, that you salvage the financial system, which is very important because if the financial system actually collapses, it has all kinds of repercussions, external diseconomies, and so on and so forth. Agreed. But now we come to your question. You failed because there was, and you went into both a financial pit and also into a kind of depression. Depression or stagnation or whatever it is. Your economic level of activity was very low and so on. And you thought that by injecting this money, you will come up. I think if I understand, this is your question. Now, injecting this money to the bank, and this is what the first lecture was actually all about. And partly what I was telling her also, that it's neither. Now, will the banks lend the money? Ask yourself the question. The banks have got the money, so they have got enough reserve. Okay. So they can actually, they have no problem now in terms of, standing there, their immediate crisis is over. But is the economic crisis over? Is the economic crisis employment? Why not?
Given out to the borrowers, they paid the CEOs.
But why wasn't it given out to the borrowers?
Because they were playing it safe. They didn't want to,
The financial, not the financial, the journalistic term and fairly descriptive term is the investment climate is still bad. You go and ask anybody, the investment climate is still bad. So whom shall I lend it to? This is what the banker said, that you want us to lend, but whom shall I lend it to? We have, we cannot lend it to people who have really viable investment projects. Okay, so we don't lend. The money sits with the bank. This is what I was saying in the very first day. So it becomes a subtraction from your injection of demand into the system. Okay, and this is exactly where the American economy got stuck and is still stuck today. Because until the investment climate picks up, this is what is called the stimulation mechanism, right? As opposed to this, the direct mechanism of the Keynesian argument in a depression or in a serious recession would be what? The state is also the investor. It's a question of the agency, right? Precisely because in a depression, and this would be also my view, precisely because in a depression you cannot, nobody, because everybody is doubtful whether the sales expectations would be realized. And in most cases, it would not be realized because the markets are really shrunk. The amount you can sell has shrunk. So what do? Either you directly stimulate the economy, and you cannot stimulate this through the bank. That is the practical point which we are asking. You cannot stimulate them through the bank by saying that, here, I give you more money, you lend it. It can work only if you give more money, it brings down the interest rate, blah, blah, and then this in lower cost of borrowing allows investors to invest and so on, like in your textbook economics. But it doesn't happen that way. And in America, the interest rate already was at a rock bottom. So what do you do in this case? Just for the same reason for which monetary policy does not work, this will not work. Demand is not there. So actually, the difference between the American style and now the European style stimulation package and the traditional Keynesian difference is very simple. It's a very simple point. In hundreds of places, I have repeated it here and abroad. And I repeated that it cannot work because if you are already in a bad investment climate, then the first mover must be the state, to stimulate the demand and so on. Actually, for whatever reason, just 1 minute, and the practical politics, Obama said he will do it. You remember in the very first time he said he will do it by spending all the money on the environment. Nobody can disagree with that. So the government will stimulate, but after a little bit it got stopped because they had not actually worked out investment schemes. This I know from my American friends. They had not worked out investment schemes by which actually they could really absorb a large amount of investment. Yeah, I think he was, yeah.
Even at the cost of letting financial institutions fail? Should the government even increase its expenditure even if it means the financial institution will fail? I mean, should they, at the expense of the financial institutions, increase their expenditures? Is that what you're saying?
Well, there are two elements to to this kind of a question. The government can, to put it more simply, government can always create money and without subtracting from anybody else. Simply printing notes. Okay? If it is agreed between the Fed and in the American system it is difficult because the Fed is a completely independent institution. But in Europe, certainly they can do it. And this was the original method. When you said deficit financing, the government simply said, I owe you, and it could print. In the American system, it became the government actually does open market operation, right? To inject money into the system, it buys. They did not do it if you're talking about the 2007 crisis. They actually, more or less, the government got the money from its own treasury and existing thing, and just the first round, 700, they injected. Okay. Now, what they actually ended up by doing, without making the politics too explicit, is they ended by saving the banks and the financial system and the large insurance companies, but they were actually far short of saving the employment and the economic system. When people say this, I have my most favorite sort of end story. And this is not from me, actually somebody who has asked this question was a physicist, very well-known physicist, Feynman, before he died and long before this financial crisis, this particular one. And he was asked that, well, I do not understand that why don't you save the system? Why don't economic policies, why are economic policies so unscientific and so on in the United States? Feynman gave a very good answer. He said, I don't know any economics, I don't, but I know it's, the economy is very complex, blah, blah. But he said, you see, one thing I do know, that suppose your economic theory is right, okay? And you actually predict that if you only give money to the banks and then don't do anything else to salvage. I'm now expanding on Feynman. You give money to the banks, then, and you predict that, this will lead to saving the banks, but not the economic system will not get stimulated enough. What would be the answer? The answer would be yes, this is true. But if my interest is banks, I would go along, this is a fine solution. Okay. That is, even if the economic theory, and this is for all of the young, whatever it is, people who are interested in policy, interested citizens and so on, that even if your policy is, even if your economic theory is right, and you are able to predict that this will generate or this will lead to the continuation of the recession. But if my interest lies in letting the recession continue and my making the money, and my making the money means Goldman and Sachs, then this is fine. In philosophy, you call it, you cannot go from an is proposition to an ought proposition, an old proposition of David Hume. And which is, that is, what it is not something which can give you what it should be. That requires, that bridge is gapped by who rules, who has the social power. I can't hear.
But extending the model where you have the real financial and the financial corporations and the financial institutions. Let's say, like, including the real, let's say there's also uncapitalized commons that we have, which are not yet in the circuits of economy. So what would be the impact, like for instance, forests, rivers, and basically, the idea of primitive accumulation is what I'm hitting at, basically like encroachment of commons trying to basically create property and capital out of them. So can that also be incorporated in that model, and how difficult would that be?
Well, I can give you a part answer. If you see in input-output analysis in economics and so on, there are two types of things, or in common sense, you can think of two types of inputs and outputs in the system. Okay. One kind of thing is what is produced inside the system. Coal is required to produce steel, steel is required to produce coal, both are required to produce electricity, so on. And this makes a tremendous simultaneous system of simultaneous equations or inequations, whatever it is. That is what we call usually the input-output table. Okay. Now, these are the produced inputs of the system. The system, if you give more other inputs, the system can produce more of it. There are two inputs which are not produced inside the system, and in the matrix you keep them in the border. One is labor, okay, and the other is natural resources. Whatever you call it, one natural resource or several natural resources, land and water reserve, whatever it is, whatever you cannot easily produce, you cannot produce inside the system. Now, using the same inverse matrix and so on and so forth, by solving the system of equations, what you can find out, you can reduce the entire system to say what is the direct and indirect amount of land which is needed. What is the direct and indirect amount of water that is needed? Okay? Because everything else is given up, only these things which are they're treated as constant, they're given, and you reduce everything to how much of direct and indirect is needed for this. And these are the ones which set you the ultimate ecological limit to the system. I mean, I don't mean in the long sense of the term, but in the immediate sense of the term. And this is where actually much of the problem arises, because when you, for example, look at India's industrialization today, I have tried to do some calculation myself, with numbers. You find exactly the same problem. That you see a corporation requires very little land in terms of it can go high, skyscraper, okay? But if you look at the electricity it needs, if you look at the, if you calculate all the direct and indirect input it needs, the steel it needs, and to produce the steel, the coal it needs, to produce the coal, the, land it needs for mining and so on. It works out to be a ratio anywhere between 1 to 10, 1 to 20 compared to natural production. That is where you are more or less directly using the inputs. That is the maximum I can say. And and of course the pricing it, if you believe in pricing, I don't, but if you believe in pricing in a certain way, then there are of course a way by setting it up as a constraint maximization problem, which Professor Karmeshu and Anjan Mukherjee and all of them all the time keep on doing, and you set up the Lagrangian multiplier and you say the Lagrangian multiplier gives you the strength of the relative scarcity of the land or whatever it is, whatever resource you are considering. You can calculate a price of it, you can calculate an intertemporal price of it, but I think all these are really not the issue. The issue really is if you cannot get a producible resource inside the system, it is the producible system which had to adjust rather than what can be produced inside the system. And that is where the fight has been. Mostly the political fight in India over, what is development, what is industrial, and that is where the fight has been.
If you look at the social accounting metrics, that's where land is a factor of production. The factors of production are labor, land, and so on. In case of certain economies along the coast, Vietnam, for instance, fish is a factor of production. So I presume, having studied in JNU with lots of Bengalis, fish should be a factor of production. Happy New Year. (9:30) tomorrow. So we'll have Dr. Petri Purainen talking about the